Welcome to the Deep Dive. We're here to cut through the noise and give you the essential insights you need. Today, we're plunging into OppFi Inc. They're right at the heart of this huge unsecured personal loan market, now $232 billion, believe it or not. So the big question, is OppFi, this misunderstood growth story, using AI, getting record revenue, but still heavily shorted? Or is it more like a high wire act? No safety net, maybe teetering on the edge. Let's find out.
Yeah, our mission today is to really pull apart OppFi Inc. That's ticker OPFI. It's a fascinating company, really trying to serve this massive group of people who, well, often get overlooked by traditional banks. By the end of this, you'll get its business, its financials, and this intense debate about its future.
Okay, and just so everyone's on the same page, all the data we're using is anchored to August 21, 2025. The reference share price for OppFi is $9.59. Let's kick off with Chapter 1, business analysis. So first things first, OppFi, they aren't actually a bank, are they?
No, exactly. That's key. They're not a bank. Think of them more as a technology platform, almost like a sophisticated matchmaker connecting consumers who need loans with banks that want to lend.
Okay.
It's built on this thing called the bank partnership model. And this structure, it's quite clever. It lets them operate across the country. They don't need individual state licenses because they use the federal charters of their partner banks.
Right, leveraging the bank's license.
Precisely.
Yeah.
And their revenue. It comes mainly from interest and fees on the loans they help set up.
Got it. And the loans themselves? What are we talking about? Oppa loans?
Yeah, Oppa loans are their main thing.
Yeah.
Unsecured personal installment loans. Usually $500 up to maybe $5,000. The structure is pretty straightforward. Fully amortizing, fixed payments, simple interest, and crucially, no hidden fees. Zero origination, zero late fees, no penalty if you pay it off early.
And they're fast too, right? Same day funding.
Often, yes. For approved applicants, that speed is a big draw if you have an unexpected expense.
And this is interesting. They actually help people build credit.
Yes, that's a significant benefit. They report payment history to TransUnion, Equifax, and Experian. So if you make your payments on time, it can genuinely help improve your credit score over time. That's huge for many people.
Any other services?
Yeah, they have the OppU blog for financial education and something called the Turn Up program, which is interesting. If you apply but might qualify for a lower rate elsewhere, they try to connect you.
That's actually pretty good. So who are their typical customers?
They focus on what the industry calls credit-challenged Americans. It's a massive group, maybe 60 million people. FICO scores often below 650. But, it's often misunderstood. These folks typically earn around $55,000 a year. They just might not have much savings for emergencies.
And OppFi's been doing this a while.
Since 2012, they've processed over 14 million applications, facilitated over 2 million loans. So they have a ton of data on this market segment. A real treasure trove.
Okay, so it looks like a dual value proposition. For consumers, quick cash, transparency, credit building potential. For banks, access to this big market without building the tech themselves, deploying capital for high yield. Makes sense.
Exactly. Now, stepping back to the industry itself, this unsecured personal loan market is huge. $232 billion in 2023. Just 2 years before, it was $146 billion. So massive growth.
Wow.
Fintechs like OppFi have really pushed that using tech and alternative data. But it is sensitive to the economy. Rising interest rates, for example, can squeeze fintechs.
And who are they competing against? It must be crowded.
Oh, it is?
Yeah.
You've got traditional subprime lenders like World Acceptance Corporation, even pawn lenders like Easy Corp,
Right.
but also other fintech platforms. LendingTree is more of a marketplace. Atlanticus Holdings is maybe a closer comp in some ways. And then you have companies like Dave Inc., but they're more focused on smaller short-term advances with a subscription model. Different approach.
Okay, but let's get to the elephant in the room, the regulatory environment. This seems critical.
Absolutely critical. It all revolves around state usury laws, the caps on interest rates. OppFi's bank partnership model uses interest rate exportation. Essentially, their partner banks, which are based in states with high or no caps, can export those rates nationwide.
And that's how they can offer loans with APRs up to, what, 195%?
Correct. That's the mechanism.
But that sounds controversial, the whole rent-a-bank accusation.
It is. Highly controversial. Critics call it a loophole. There was a court case, Madden v. Midland Funding, back in 2015 that created uncertainty. And there's this constant background noise, pressure for a federal 36% APR cap, like the Military Lending Act has. If that happened, it would fundamentally change, maybe even cripple their business. It's a huge risk.
So that's the big cloud. But what keeps competitors out? What are OppFi's defenses?
Well, first, just navigating that complex regulatory setup for the bank partnership model is hard. It's not easy to replicate. Second, their tech. That proprietary AI underwriting, the data moat from over a decade, 15 billion data points. That's significant. Third, those established relationships with the FDIC-insured banks. Takes time to build that trust. And finally, brand trust. In this sector, building a good reputation, which OppFi seems to have done, is a major hurdle for newcomers.
Okay, so summing up their competitive edge.
Strong brand, definitely. High customer satisfaction, 79 NPS, A plus BBB, 4.5 on Trustpilot. That's pretty good. Cost advantages from scale. That Model 6 AI automating 80% of approvals cuts costs. What we call soft switching costs. People come back because of the relationship, the credit building. But the unique asset really is that Model 6 AI platform itself, analyzing 500-plus attributes, claiming to boost originations while cutting charge-offs. That's the key operational advantage.
All right, that gives us a solid picture of the business. Let's shift gears to the people in charge. We're now into Chapter 2, Management Evaluation.
Looking at the leadership, you've got Todd Schwartz, the founder and CEO, over 13 years there. So deep history. Pamela Johnson, the CFO, has really relevant experience from other non-prime lenders. That's valuable. And Christopher McKay, Chief Risk and Analytics Officer, also over 10 years. Background at Capital One, HSBC, solid risk credentials.
10 years seems pretty good, too.
Yeah. Average tenure for management is 4.2 years, and the board is even longer at 7.3 years. Suggests stability.
Okay, but how do they handle communication and, well, the ethical side? They call themselves mission-driven, but those high APRs attract scrutiny.
It's definitely a tightrope walk, as you said earlier. They emphasize transparency, customer satisfaction, financial inclusion. But the business model itself, relying on that high APR structure facilitated by bank partnerships, draws constant fire from consumer advocates and regulators. It's an ongoing reputational and, frankly, ethical challenge they have to manage carefully.
And where are they investing their capital?
Primarily back into the core technology. Enhancing those AI models is job one. But they're also open to acquisitions. They did the Biddy transaction to get into small business financing. So looking to maybe diversify.
Now, this is a big one. April 2024, they announced a share buyback A&D, a special dividend.
Yes, a $20 million share repurchase program and their first ever special dividend, $2.12 per share. And the CEO, Todd Schwartz, was very explicit. He said he believes the stock price is disconnected from OppFi's intrinsic value. That's management putting its money where its mouth is.
But there's a conflicting signal, isn't there? Insider selling.
Yes. This is where it gets complicated. The company buys back stock, says it's cheap. But over the last 12 months, insiders sold a lot more than they bought. Over 14.4 million shares sold versus only about 409,000 purchased. And the co-founder, Theodore Schwartz, has been a particularly consistent and significant seller.
So the company says buy, but insiders are selling. That's confusing for investors.
It is. It's a definite divergence you have to weigh. Why are they selling if it's so undervalued? Good question.
Let's talk about that return on invested capital, ROIC. You mentioned it was impressive.
Extremely impressive. A September 2024 report put their ROIC at 28.10%. Compare that to their weighted average cost of capital, or WACC, around 8.53%. That ratio, ROIC to WACC, is 3.29. It blows peers like Catapult, 0.60, and Moneyline, 0.41, out of the water.
Wow.
It shows incredible efficiency and profitability. But, and this is the crucial but, that high return is directly tied to those high APR loans. So the profitability carries the exact same regulatory risk profile. The source of the strength is also the source of the biggest risk. It's a lightning rod.
Okay, let's crunch the numbers. Moving into Chapter 3, financial analysis. Let's get a financial snapshot as of our anchor date, August 2025. Share price $9.59. Market cap around $272 million. Shares outstanding 28.36 million. Forward PE non-GAAP was low at 6.95x. Price sales also low, 0.71x. Debt to equity was 2.09x in Q2 2025. That ROIC again, 28.0%. No regular dividend, just the special one.
Looking at revenue growth over 5 years, it's been strong. 2020, $200 ings, then $350, $453 ins, $509, $526 in 2024. Growth rate slowed a bit as they got bigger, which is normal. 2024 was 3.3%. But their 2025 guidance midpoint suggests a reacceleration, aiming for about $591.5 million. That's around 12.4% growth, so still pushing forward.
And profit margins, Q2 2025 looked pretty good operationally.
Very good. Total revenue, $142.4 million. Net revenue margin, that's after the cost of lending, essentially was a healthy 70.4%. Operating margin was 31.5% or $44.8 million. Shows the tech platform is efficient. But then the GAAP net profit margin was only 8.1%, $11.5 million.
Right. That big difference because of the warrant liability adjustment.
Exactly. A $33.3 million non-cash charge is an accounting thing, doesn't affect actual cash flow. That's why looking at operating income or their adjusted net income, which hit a record $39.4 million, that quarter gives you a much better sense of the core business health.
And the free cash flow story sounds impressive.
It really is. Management keeps highlighting it. The trailing 12-month free cash flow per share absolutely surged. Like December 2022 was $2.73. By December 2023, $17.52, and $17.94 by March 2025. That shows incredible cash generation power. Gives them lots of flexibility for buybacks, dividends, or whatever they choose.
Okay, so financially stable. Seems like it, operationally.
Yeah, 8 straight years of annual profit through 2022. That debt to equity at 2.09 is moderate and improving. The current ratio isn't very meaningful for finance companies, but overall stability looks okay, operationally speaking. Again, no regular dividend history, just that special one.
Let's talk valuation. How does it stack up against peers?
Relatively speaking, it looks cheap. That forward PE of 6.95x, significantly lower than most peers. EZ Corp is over 11x, Atlantic is over 10x, LendingTree over 14x. So the market is definitely applying a discount, likely pricing at that regulatory risk we keep coming back to.
Okay, so relative valuation says maybe undervalued. What about intrinsic value, using something like a DCF?
Right, a discounted cash flow model. The basic idea is, what are all the future cash flows worth today? You project out future free cash flows, then discount them back using a discount rate that reflects the risk.
And what does your educational model suggest for OppFi?
Our model estimates an intrinsic value range of $13.50 to $17 per share.
And what are the key assumptions behind that range?
We were pretty conservative. We assumed 10% annual revenue growth for 5 years, then tapering to 2.5% forever. That's actually below company guidance and analyst growth expectations, building in some cushion. And for the discount rate, the WACC, we use 9.5%. That's intentionally higher than the 8.53% sometimes cited. We bumped it up specifically to account for those significant legal and regulatory risks, trying to factor that uncertainty into the valuation itself.
Okay, we've covered the business, management, financials. Let's switch to how the market feels. Time for Chapter 4. Market sentiment. What are the professional analysts saying? You mentioned they were bullish.
Overwhelmingly bullish, actually. 4 analysts cover it. Consensus is strong buy. The average one-year price target is $14.67. That's about 53% potential upside from our $9.59 STR reference price. High target $16.80, low $13.50. And JMP Securities upgraded to market outperform back in May 2025. So analysts see value.
And recent news has been positive too, driven by earnings.
Almost uniformly positive news flow lately, yeah, especially after that strong Q2 earnings report on August 6th. Beat estimates, raised guidance, financial media headlines picked up on that positive story.
Here comes the contrast. Market indicators, specifically short interest, it's huge.
Massive. As of mid-August 2025, 19.91% of the public float was sold short. That's 5.35 million shares. It's an exceptionally high level, signals a lot of capital betting against the stock, convinced there's a fundamental flaw, almost certainly that regulatory overhang, a real standoff.
19%. Wow. And the days to cover?
Also high, at 4.91 days, meaning it would take almost 5 trading days for all shorts to cover. This sets up the potential for a short squeeze. If good news hits, or if the regulatory fear fades, shorts might rush to buy back shares, causing a rapid price spike. High risk, high potential volatility.
And technically, how does the chart look?
Not great, frankly. Bearish. The $9.59 price is well below its 50-day moving average, which was around $12.26. That's negative short-term momentum. It's also just slipped below its 200-day moving average, around $10.30. That's a key long-term trend indicator. Falling below the 200-day suggests the long-term uptrend is broken or at least seriously threatened. So technically, the bears are in control right now.
Okay, so a clear disconnect between analysts and the market action. Let's see who actually owns the shares. Moving to Chapter 5. Ownership structure.
This is another fascinating contrast. Despite that negative sentiment and high short interest, big institutions are buying. There are 255 institutional owners holding over 17 million shares. That's about 60.1% of the company. And we're talking big names. BlackRock, Vanguard, Millennium Management, Renaissance Technologies, Morgan Stanley. The smart money.
And they're adding to their position.
Yes, that's the trend. In the last reporting period, 108 institutions added 5.7 million shares. Only 49 decreased, selling just 1.25 million. So significant net accumulation. It's a strong vote of confidence from long-term investors, countering that heavy short interest. They seem to think the risk is manageable or overly priced in.
But we still have that insider selling issue.
Right, we have to keep coming back to it because it's such a direct conflict. Institutions buying, insiders selling. Founder CEO Todd Schwartz still holds 2.0%, about $17.3 million, so he has skin in the game. But again, over the last year, insiders sold 14.4 million shares, bought only 409,000. And co-founder Theodore Schwartz, a consistent seller, it just doesn't align with the company buying back shares and saying they're undervalued.
So the ownership structure is changing. Less founder control, more institutional.
Exactly. It seems to be transitioning from being very tightly held by the founders to having broader institutional ownership. This is pretty typical as companies mature post-IPO. It suggests sophisticated investors see it as a potentially undervalued asset, even with the risks, while founders might be diversifying.
All right, let's consolidate all the potential upsides and downsides. Time for the critical chapter. Chapter 6, Risk Assessment.
Okay, let's break it down with a SWOT analysis. Strengths, weaknesses, opportunities, threats.
Strengths.
That proprietary AI underwriting Model 6 and the deep data moat are huge. High profitability, that industry-leading ROIC we talked about. Strong brand reputation and customer satisfaction scores. Experienced management team.
Okay, weaknesses.
The big one. Over-reliance on that legally challenged bank partnership model. High concentration in the subprime segment makes them vulnerable to economic downturns. The business model itself, based on high APR loans, invites negative PR and regulatory heat. And those volatile gap earnings, due to the non-cash warrant adjustments, can confuse investors. Now, opportunities. Huge untapped market, potentially 60 million U.S. consumers. Room to expand into adjacent products like they did with small business loans. Could leverage their tech platform more, maybe offered as a service to other banks, and as we discussed, that potential for a short squeeze as sentiment turns.
And finally, the threats. This is where the rubber meets the road.
Absolutely. The number one threat, truly existential regulatory risk. A federal 36% APR cap, or a court ruling against the bank partnership model. That could be game over or drastically shrink the business. Other threats, a severe recession driving up defaults significantly. Intense competition, rising interest rates increasing their own borrowing costs.
How do broader economic factors play in? Inflation, interest rates.
Well, inflation can actually boost demand for credit initially, as people struggle, but it also hits disposable income, increasing default risk later. So double-edged, interest rates directly raise OppFi's funding costs. But maybe more importantly, Fed rate hikes are designed to slow the economy. Economic slowdowns, recessions, job losses, that's the bigger threat to OppFi via loan losses, even more than slightly higher funding costs.
And even things like tariffs, could that impact them?
Indirectly, yes. Something like new U.S. tariffs, as seen in 2025, acts like a tax on consumers. That strains budgets for OppFi's core customers, the ones already living paycheck to paycheck. So it absolutely increases credit risk across their entire loan book. Everything's connected.
Okay, we've covered a lot of ground. Let's bring it all together. We're at the Chapter 7 conclusion.
Let's summarize the bull case first. OppFi runs a highly profitable, very efficient business. That ROIC proves it. They generate strong free cash flow, enough for buybacks and dividends. They serve a massive market that traditional players often ignore or can't serve effectively. They have a real tech advantage with their AI underwriting. And based on standard metrics like PE and analyst targets, the stock looks significantly undervalued.
Okay, now the bear case.
The bear case is almost entirely focused on that overriding regulatory and legal risk. Is the bank partnership model sustainable? Their profitability is directly tied to those high APRs enabled by that model, which critics see as predatory or a loophole. This isn't just noise. The market is pricing this risk in heavily. Look at the 19.91% short interest, the weak stock performance. Heavy insider selling adds fuel to the bearish fire. And the business is fundamentally vulnerable to a sharp economic downturn, hitting their borrowers hard. So our valuation summary. Our educational DCF model, trying to balance growth and risk, puts the intrinsic value between $13 and $17 per share.
Giving us our concluding outlook. As of August 21st, 2025, the share price of $9.59 is well below both that intrinsic value range and Wall Street targets. That gap really represents the market's discount for the perceived probability of something bad happening on the regulatory or legal front.
Right. So investing in OppFi today isn't really a bet on whether they can run their business well. They've shown they can do that. It's much more a calculated bet on whether their legal and regulatory foundation will hold up. The decision for you, the listener, really comes down to how you handicap that binary risk. Is the discount big enough to compensate for that threat?
That's a great way to frame it. If that regulatory risk is the key variable, what specific signs should you be watching for? What news would indicate that risk is either getting worse or maybe starting to fade? Something to think about.
Well, that wraps up our deep dive on OppFi. If you found this valuable, please like and subscribe to Stock Analytics AI. Remember, members paying €499 a month get priority deep dives on tickers. We're covering all S&P 500 stocks over the next few months, and members get exclusive priority access. Want a one-off deep dive on a stock you're watching? Just drop us a super thanks. And the necessary disclaimer. Please remember, this analysis was generated by an AI system for educational purposes only. It should definitely not be considered financial advice. We strongly encourage you to do your own thorough research or consult with a qualified financial advisor before making any investment decisions.